All right, in this last video, we're going to do some interesting stuff. We're basically going to look through a whole bunch of studies and talk about alphas that other folks have found in their research. Okay, so it should be pretty interesting. But before we do, let me highlight something that we talked about at the beginning of chapter 9. So we talked about the assumptions that were necessary in order to estimate or to derive the capital asset pricing model. And we talked about some of the issues of those things, right? First, we talked about no transaction costs. By the way, uh, another important assumption in the no transaction costs is they don't allow for short selling. Okay, so what happens if we relax this assumption or we relax the short selling assumption? Are there alphas to be had? How about number 6? Investors are mean variance optimizers and don't care about loss aversion, don't care about skewness. They have no preferences for these things. Let's relax that assumption and see if we can find alpha there. Lastly, investors have homogeneous expectations. What if there's disagreement among investors about what the value of a particular price or asset should be? When we relax that assumption, can we find alpha? So hopefully you're seeing that maybe what we did is we went right back to the assumptions and we said, okay, here's what the CAPM suggests. Here are the assumptions of the CAPM. We're going to add 2 more systematic risk factors, the small minus big and high minus low factor. And we're going to try to find alpha by relaxing these assumptions and seeing if alphas exist. Okay, so that's where we're heading. Let's start with this. This is interesting. Okay. This is a study that examines whether or not volatility, generally speaking, the standard deviation of returns, predicts future negative returns or has positive alpha or negative alpha. Okay? You would think that volatility is firm-specific volatility is capturing risk, or you would think that volatility would be that firms with or portfolios made up of firms with lots of volatility, that if those portfolios are sufficiently large, that all the idiosyncratic risk would be diversified away and it wouldn't matter. There would be zero alpha. Okay, let's see what these guys did. So, but basically, what they did is they got data for every month. Last month, they sorted the stocks based on volatility, and then they ran a 3-factor model trying to figure out whether or not there were alphas after controlling for the 3 factors. Get down to page 277 here. Okay, so here you go. So they sort stocks based on these are portfolios, 5 portfolios. In this portfolio, these are stocks that had the lowest last month volatility. In portfolio 5, these are stocks that had the highest last month volatility. Okay. And then they do 5 minus 1 here. Okay, this is portfolio 5 minus portfolio 1. We did the exact same thing. I think we did portfolio 1 minus portfolio 5 in the previous video, but whatever. Okay. And so look at what happens here. This is interesting. So here is your CAPM regression, and these are alphas from your CAPM. Here's your FAMA French 3-factor regression. Let's focus on these, given that that's what we did in the previous video. So stocks with the lowest volatility. So this is portfolio 1. Stocks with the lowest last month volatility have FAMA French 3-factor alphas of 0.19, that's in percent, not in basis points. The T-stat isn't significant, that's 1.34, but notice that as I go across increasing portfolios, those become stronger and more negative. Look at this, portfolio 5. These are stocks with the most last month's volatility, have a negative alpha of 0.36%. Those are in basis points. So 0.36 times 12, that gives you a negative alpha of 4.32% in annual terms. That T-stat is significant. If I buy stocks with the highest volatility and sell stocks with the lowest volatility, you understand what I'm doing here? I'm putting together a trading strategy, a hedge portfolio. You can see that the alphas on the 3-factor model are negative 0.55. Times that by 12, in annual terms, that's 6.6%, negative 6.6% alpha in this hedge portfolio. Suggesting that You would think that stocks that are more volatile should outperform stocks that are less volatile, or in a portfolio sense, that the alpha should be zero. However, it's exactly the opposite. Okay. So this speaks to the mean variance optimization assumption of the CAPM when we aren't mean variance optimizers. It appears that there's alpha. Let's go to the next one. This one's interesting. This is by Boyer, Mitten, and Vorkink. They're down at BYU. This is the expected idiosyncratic skewness premium. Give me a second. Let me go to page 183 here. There you are. So what they do here is they get a measure of skewness. They sort stocks into 5 portfolios based on skewness, and here they take portfolio 1 minus portfolio 5. Here are your CAPM alphas. Okay. So buying stocks with low skewness gives you positive alphas. Okay. We mentioned this a few videos ago when we were talking about the skewness, about negative skewness. If loss-averse investors are trying to avoid negative skewness, then the demand for these stocks is going to be low, prices are going to be low, and the alphas are going to be positive. We see that right there. That's 0.14. That's in percent. And as I go across increasing portfolios, look at this. In portfolio 5, stocks with positive skewness underperform, have negative alphas, huge negative alphas. That's a negative alpha of negative 0.65 or 66%. If I take the 1 minus 5, if I buy stocks with negative skewness, sell stocks with positive skewness, I generate a positive alpha of almost 0.8%, 80 basis points. Of course, 0.8% times 12 is almost 9.6% in annual terms. The T statistic is significant. Okay, I'm sorry, those are CAPM alphas. The FAMA French 3-factor alphas are even bigger, right? So 0.995 in my hedge portfolio, where I buy stocks with low skewness, sell stocks with high skewness, I can generate a hedged portfolio return premium, a positive alpha of almost 1% per month. Of course, that's 12% in annual terms. I can beat the market by 12%. I'm holding constant all of the other systematic risk factors using my FAMA French 3-factor model. Again, this speaks to the idea that when I relax the mean variance optimization assumption in the CAPM, I can generate some sort of alpha. Okay. What if we relax transaction costs? What if there are no transaction costs? This will be kind of interesting. So we've worked on something. This is Ryan Whitby and I. We wrote a paper that looks at the volatility of bid-ask spreads. Right. And look at what we found here. I'm almost there. So what we do here is we actually estimate a whole bunch of different multi-factor models, but we'll focus on the FAMA French 3-factor model here. And look at what we find. So what we do is we calculate the volatility of bid-ask spreads. Certainly bid-ask spreads are transaction costs, and the higher the bid-ask spread, the greater the transaction cost. So what happens if you start to account not only for bid-ask spreads, but for how uncertain bid-ask spreads are, the volatility of bid-ask spreads? I effectively get 0 alpha in stocks with low bid-ask spreads. I get positive alpha, 0.38%. Those are in basis points here, 0.38%. And that gives me a hedge portfolio of 0.33%. In other words, in annual terms, I can get about 6.6% in excess of all of the other risk factors, the 3 factors that we've been talking about. I can get about I can beat the market by about 6.6% strictly by buying stocks with in portfolios with high spread volatility and selling stocks with low spread volatility. All right. We did a follow-up study to this where we looked at the maximum bid-ask spread. So you have stocks, you have daily stocks, you have bid-ask spreads for those stocks every day. And then what happens if in one particular day you have a huge bid-ask spread, right? This probably adds, you can almost think of this as like spread skewness. This is how we wrote the paper. But really what we were most interested in was this. Okay, these are stocks with low max spreads. Those are stocks with the highest max spread. Again, you have spreads every day. And what happens on the one day where you have huge spreads? This was a paper written by Todd, Griffith, Ryan, Whitby, and I. Okay, look at what happens here. We don't have any alphas. I'll focus here on the three-factor model. Alphas are very low. The T-stat is fairly big, but those alphas are very low. Look at what happens here. We get alphas. If you buy stocks with high maximum bid-ask spreads, the alpha on those things is 1.08% per month. Right? That's over 12%. Again, this is a three-factor model. I'm holding constant all of the systematic risk that we've been talking about. By the way, I do this for we did this for other multi-factor models, and the alphas were huge, suggesting that when you relax the transaction cost assumption in the CAPM, you generate positive alpha. What happens if we look at short interest? This is also interesting. So what happens if we allow for short selling? We've talked about short selling in our class. Give me a second here to find, here you are. We've talked about short selling. Now listen, short sellers face a whole bunch of risk, all right? They're selling the stock short, they're borrowing the shares, they're selling them. They're not only can the stock price move up, and generally prices move up more than they move down. Not only can stock prices move up, but they also have to pay interest on these equity loans. So we've talked about how risky short selling is. Now listen, if you're going to sell short, you better be pretty sure that the stocks are going to go down in price. All right? You got to have some information that the stocks are going to go down in price. Now, we don't have the information that the short sellers have, but we understand enough about short selling to know that we have information that the short sellers have information. Look at what happens here. This is a four-factor model. They didn't report their three-factor model, but this is all right. So they're controlling for the market risk premium, small minus big risk factor, the high minus low risk factor, and they control for another factor called the momentum factor. And look what happens. If you buy stocks with the highest short interest, these are 45 stocks. This is a portfolio of stocks with the absolute highest short interest in the 99th percentile. The alpha is negative 1.2% per month. You're going to get creamed. On the other hand, if you buy stocks, look here, if you buy stocks, 232 stocks with the lowest short interest, the alpha on that four-factor model is 1.4%. The difference is 2.6%. These are huge alphas, all right? So another trading strategy, it appears, using a multi-factor model is buying stocks with low short interest, selling stocks with high short interest, and you're going to generate some positive alpha. All right. So if we relax the mean variance assumption, it appears we get alpha. If we relax the no transaction cost assumption of the CAPM, we get alpha. If we relax the no short selling, which is inherent, we get positive alpha. What happens if we relax the homogeneous expectations? Here's another study. So this study looks at dispersion in analyst earnings forecasts. So if analysts disagree, they have heterogeneous expectations about what earnings are going to do, what happens? Okay. Let me find the tests here. So these are stocks with low dispersion. These are stocks with high dispersion. All right. These are three-factor models. The first row in each of these is the three-factor model. Look at what we find here. When we estimate these things for stocks with low dispersion, where analysts typically agree, we find positive alpha, but that T-stat isn't very strong. When you use a four-factor model, that's the momentum factor again, you get positive alphas with a T-stat of 2.14. Stocks with high dispersion, look at how strong that is. That's a negative alpha of 0.58%. Okay, so you're looking at maybe negative 7% annually if you buy stocks with high analyst dispersion. All right, and that's significant. If you take the difference between the two, that's even more significant. So look, if you buy stocks with low dispersion, sell stocks with high dispersion, what is that going to give you? That's going to give you 71 basis points. So 71 basis points times 12 is going to give you about 8.5% per year. All right. Now the idea here is simple. When you have a lot of disagreement about what the value of stocks should be, and if short sellers are constrained, so this is a short selling argument as well. If short sellers are constrained, then stocks that have a lot of disagreement and short sellers have to be sidelined, those stocks are going to be overpriced. And that's what they're finding here in Portfolio 5. Okay. Again, if there's analyst disagreement or if investors have heterogeneity in their expectations, that could also generate some alpha. So here are 6 simple examples of back testing of these strategies that generate positive alpha in our multi-factor framework.